Welcome to Undercover Analyst. International crude oil prices are sizzling at a 10-month high after oil producers Saudi Arabia and Russia have extended their output cuts. Now, what has happened is that Russia and Saudi Arabia together have decided that they will cut 1.3 million barrels per day combined by the till the end of the year, and this has put an upward pressure on the crude oil prices. Now, with rising crude oil prices, there are lots of problem for countries like India. We'll go ahead and see what exactly those are. The economic impact of global oil supply have important implications for India because India is a net importer of crude oil, and we need a price stability in crude oil so that we can smoothly manage our economic shocks. The oil supply related news shocks cause a sustained increase in consumer prices. It can impact the value of Indian currency, and it can also reduce the domestic output. Now, what has happened is India's trade deficit has widened to 10-month high in August. Now, high crude oil prices are said to have a domino effect on the economy as the price shocks are instantly passed on to the macroeconomic indicators. So, what this means is that whenever there is an increase in oil prices and there is a widening of the trade deficit. Now, we will try to understand what is a trade deficit in the later part of the video, but the latest estimates by market analysts say that the Indian current account deficit, which measures the difference between exports and imports of goods and services, is impacted by the high crude oil price. Now, rising crude oil positively impacts oil exporters. So we are not oil exporters, we are net oil importers. And it will negatively impact oil importing countries. This is very simple economics. If there is a rising crude oil price, and if you are the seller of the crude oil, you will definitely gain from the rise of the price. But if you are a buyer of crude oil, then it will be difficult for you to, because you'll have to put out more dollars to buy the same quantity of oil. So every $10 rise in oil in the Brent crude oil which India takes, India's current account deficit will increase by 0.5%. So if you're confused what's a current account deficit, don't worry about it. We'll cover that later. And why is this happening? We see here that the crude oil prices are increasing from the last 1 month. It was at a stable $82 back in August, but now it has constantly been increasing, and it says it has come very close to that $95 mark. The problem with India is, because we are a net importer of oil, the difference between exports and imports has now started to widen. So India originally always has been in a deficit. But what happens is the problem comes in when the deficit expands and it widens because of the crude oil prices. Current account deficit is the key indicator of balance of payment of a country. And in the current scenario, the momentum has picked up on crude oil prices. And what is happening is for every $10 increase, which has now been like more than $15, the rise in the price of crude, the current account deficit will increase by more than 0.5%. So now let's try to understand what exactly is current account deficit. A country has flow of goods, the services and investments come into the country and go out of the country. So very simple concept here. See, the value of goods and services we import, if that is greater than exports, the country is supposed to be in deficit. And if the value of goods and services we import is less than the exports, which means we have a surplus. It's very simple economics. So India is a net importer of oil. Now, we don't export oil, we import about 85% of our oil needs. And that's why the current account deficit of India is, the current account is in a deficit. And that's why we always try to measure the CAD, the CAD. And if that widens, that could be a problem. Now, see if in the quarter from Jan to March, it has been $1.3 billion. And in the next quarter from April to June this year, it has widened to $10 billion. Now you can see a vast difference here from 1.3 to $10 billion. The current account measures the flow of goods, services, and investments in and out of the country. So the country runs into deficit when the value of goods and services we import exceeds the value that we export. It's very simple economics. Now, let's consider a simple example here. If let's say the exports are 100, now I've just kept 100 and not put any currency sign over here. And also I'm just taking it as a major component export and not dividing it into goods and services and capital. Just take exports as 100 and imports at 110. So what happens if you subtract that, that's like net export is minus 10, which means we are a net importer. Now, if you get a minus 10, that means the economy is in deficit and the trade balance is in deficit. Let's consider the other scenario. The export is 100 and the imports are only 90, which means the net export is plus 10. Now, this is a current account surplus. Okay, and who are the countries who have current account surplus? So there are many countries which are at current account surplus, because see, the ones those who are exporting more than importing are actually the countries which are in surplus. The biggest example is China. China has for years been into current account surplus. So their economy works very different to what India's economy will work. Now, 85% of the energy needs in India are through imports. Now, what happens because of this? We see a heavier import bill if crude oil prices keep rising. And what is happening, I already showed you, the crude oil prices have gone up from 82 to $95. Now, the biggest threat is if it stays above 95 for a longer period, let's say for the next couple of months or maybe 3 or 4 months, that will be a big problem, because we have the elections coming up. And if the elections, if they at the time of election, uh, the uh, the government generally would like to cut the petrol and diesel prices so that it can favor the general public in case it wants to win the votes. And that's a populist thing which every country does, every government does. But the problem with that will be the prices are not less in the international market, and so they have to bear a loss from our own pockets, and that means the oil marketing companies will have to take a loss. The other important point here is uh, the high oil prices push the US dollar above against its peers. And this is the big problem. So when you buy a barrel of crude oil at $85 and when you buy it at $95, the difference is not only $10, but the problem is that this increase in $10, what it does is it asks you to buy more of dollars, and which pushes the dollar up against your own country's currency. Now, I think this may be difficult to understand, but it's very easy in terms when you think that in the past couple of months, rupee has been under constant pressure against the dollar. The heavy reliance on oil imports has driven energy costs up and putting pressure on the stability of Indian rupee. And as the Indian rupee weakens and import expense rise, inflation will keep on increasing. And that will pose a significant challenge to the India's economic growth. Now, a strong dollar can weigh on oil demand by making the fuel more expensive. And as and when we see the rupee under pressure and dollar increasing, that will be a troublesome scenario for India again. These two companies would be under pressure for the next couple of quarters, definitely, because Bharat Petroleum Corporation and HPCL, these are the two oil refineries. And the problem with this is they will be forced to cut the rates as far as the elections are concerned. And that's why they will have to take a loss. Now, the OMCs did not significantly increase the retail price last year, even if when the crude oil was at $140 a barrel. So oil refineries are going to register loss on their selling price of petrol and diesel, and that's going to be a big problem. The stock prices of OMCs also witnessed a significant decline already, because the crude oil prices have been going up from the past 1 month. So they were already under pressure. And if the rise of crude oil continues, there is going to be a significant problem here with Bharat Petroleum and Hindustan Petroleum, the two biggest oil refineries in India. The other big concern is that the stability of oil prices. If the oil prices remains above 95 or maybe reaches above 100 and stays there, that's going to be a big problem for these two companies, and not only these two companies, the overall economy of India might suffer. So where are crude oil prices sitting now? So oil prices hit a 10-month high, and it's post a third weekly gain as supply is tightening from Saudi Arabia and Russia. And there was optimism that Chinese demand might lift up crude oil, but that's not actually happening. It's not the supply, it's not the demand from China, but it's actually the supply cut from Russia and Saudi Arabia. And why all this is happening? Because oil producers Saudi Arabia and Russia extended their voluntary oil output cuts, and they combined they are cutting like 1.3 million barrels per day. Now, in this, Saudi Arabia has cut approximately 1 million barrels per day, and Russia has restricted the output by 300,000 barrels per day. So these are on top of the April cut, and this is going to happen till the end of December this year, 2023. And this will, the OPEC produces about 30% of the world's crude oil, and when these two countries talk about cutting the crude oil supply till December, it's going to have a huge impact for countries like India. So, what is the problem, and how does the high crude oil prices impact the Indian economy? First, it's going to be a high import bill. Like we had discussed earlier, we import 85% of the oil, so it's going to be a high import bill. It will lead to high petrol and diesel prices. That's very obvious. And the depreciation of Indian currency, that's the third point. It's a very vital point, and because that will impact the overall economy. What happens if there is a depreciation in the Indian currency? And all this leads to a high fiscal deficit. We are already in a fiscal deficit, and this will widen the gap. So there's another problem. India's balance of trade, like we saw earlier, the exports is shrinking and the imports are remaining the same, and the imports are becoming expensive, and that will be a big problem. Inflationary pressure, because high petrol and diesel prices would lead to high transportation cost. High transportation cost will lead to higher vegetable cost, higher fruits cost, and all these things. The grocery cost will go up higher, and that will contribute considerably to the inflationary pressure. And what all this leads to, what all the 6 point leads to, is the most vital point, is a lower economic growth. And we were trying to come out of the COVID, and since then there has been a very positive economic growth on India's side. But this can now hamper the economic growth and push the expected GDP growth uh, a couple of points lower. And if this crude oil price stays above 95 or reaches 100, and who knows, if the economic situation goes bad, it can also go up to 120. Let's talk about Nifty 50. Nifty has been in a superb run from the past 1 year, at least from the start of this year. And what will happen is, if there is ever a fear of declining economic output or increasing crude oil prices, that will lead to certain pressure on the Nifty 50s, because the top 50 stocks will certainly face the economic pressure. What's happening right now is the markets are not ready to digest any of these bad news, and what certain economists are saying, it could be that they are very optimistic about anything and they are forward looking. So it could be that they are in an irrational exuberance, is what the economists say. But it feels like the markets will never go down, but that never happens. And with time, we'll see that Nifty will come under pressure and might have a good correction when the economic growth slows down. If you like this video, please share, subscribe,